We're just getting all of we're getting everything in order. And what I'd ask everybody to do is please make sure that you're on mute as we get started, so there's no feedback. We are going to open it up for questions at the end of our presentation. So we will have the opportunity for you to ask questions of us. So we look forward to getting those questions from you. We're going to give people just a few more moments to get logged in. You notice we are recording this session and we are going to post it on our website. So if you don't want to see your picture on our website for the following presentation, you may want to switch it to where we don't see you. You're welcome to stay on your video, but if we are going to be posting this on our website as well. So once again, Lorraine Gilbert, Wealthwise Financial, and we're going to start in just 2 minutes. I'm going to give everybody just 2 more minutes to get logged in, and then we'll get started. Okay, if you're just logging in, we're giving people just a moment to get logged in and settled in. And then we're going to start our mid-year outlook presentation. I'm going to be sharing my screen. As I mentioned, we are recording a session, and so and we will be posting it on our website following the presentation once it goes through compliance for review. So I'm going to go ahead and share my screen so we see my screen. And Krista, if you'll just confirm with me once the screen is up and we can see the presentation. So
yep, we can
Krista,
see it.
can you see that?
Yes.
Perfect. Okay, so we'll go ahead and get started. So once again, welcome. I'm Lorraine Gilbert, CEO and founder of Wealthwise Financial Services. Happy to be here today to talk to you about our mid-year outlook for 2021. And what we do here is we like to do 2 presentations a year, mid-year and end of year. So mid-year, looking back, what's happened since the beginning of the year, and looking forward, what we are expecting the rest of the year. And at the end of the year, we look back at the last year, and then we look forward at the year ahead. So I thought I would just start with recapping a little bit about what we said at the end of 2020. Some of the things that we talked about at the end of 2020 is that we were in recovery economically from the pandemic and from the recession, and that we would continue in that recovery. We saw a rotation of going from large cap to small cap, and a rotation from growth to value that we expected. And we also saw thematic areas like innovation being areas to invest in. We talked about sector overweights as far as healthcare, financials, technology, and a barbell, meaning a balance between growth and value. On the fixed income side, we talked about that high quality fixed income, which is actually less attractive in recovery, and that we would be looking to other areas of the fixed income. So now let's talk about where we are and what we've been doing on your behalf. So where we are in, and when we look at the economy, we're certainly in that recovery mode. We're in earnings season, looking at Q2. And what we're seeing in the Q2 earnings is a substantial recovery from Q2 2020. And we've seen growth, in a sense, peaking, the economy peaking. We'll talk about that a little bit more. We still think there's enough momentum in the recovery to drive above average growth, not only 2021, but going into 2022. And we're expecting our 2021 GDP number to be 6.5%. And so we'll talk about that. We'll show you where analysts were saying at the beginning of the year, what they're saying now. We'll go through all of that data with you. As far as equities are concerned, the second half of the year in a bull market is typically more challenging than the first half of the year, but historically still has produced gains. And so what that means is, and as you've seen, we've had a huge run up in the market the first half of the year. And then while valuations are elevated, we still think that there's room because of a low interest rate environment. And that has a lot to do. In a low interest rate environment, valuations are higher. As interest rates go up, valuations are lower. So it all has to do with where interest rates are. And we are still seeing low interest rates. We'll talk about the Fed and what we see there, but they are, we just heard this week, just yesterday, that no movement as far as interest rates are concerned. We expect that to continue. On the fixed income side, we don't expect a lot of upside on core investment grade. And that's what we said at the end of the year. That's what I was talking about. In talking about high quality was less attractive. And yet there's still a room for fixed income for most people. Most people are not comfortable having 100% equity in their portfolio. Some of you are, most of you are not. We're going to talk about that. We're going to show you what's been going on in the fixed income and the equity markets, but definitely the fixed income plays an important role as a diversifier when there's volatility in the markets. It helps you not be 100% subject to the volatility in the equity markets. So let's talk about year to date what we've seen. So the way we divide this up is the nine Morningstar style boxes on the left-hand side. So you can see the matrix here. The large cap value is up 17.6%, large cap blend 18.1, large cap growth 17.4. Now let me put some context into what you're seeing here. We started out the year with value going gangbusters, and growth was actually lagging behind. It's only of recent where growth caught up to value. And you can see, and like we had said, that this year we saw this kind of ballast between growth and income, and you can see that. But at the beginning of the year, value was taking off. The other thing you'll notice is look at the numbers, look at just small cap value, up 22%. And what we had talked about was that movement from large to small, or even mid and small. And you can see that as well. We talked about growth to value. You can see those numbers. So in many ways, the numbers that we were talking about have played out. If you look at the indices on the right-hand side, the S&P 500 is a large cap blend indices, up 18.1. So that's why on the left-hand side, you see that same number in the large cap blend. Look at some of the other numbers. The NASDAQ up 16.9, the Dow Jones up 14.8, MSCI All Country World Index up 12.4, and emerging markets up 7.2. Now on the fixed income side, what you see is the Barclays Ag is down 0.6%. So that's less than 1%. But to what we talked about at the end of the year, the Barclays Ag is not necessarily the place to be. If you look at other areas of the fixed income market, like high yield bond is up 3.9. If you just look at some other areas of the market, high yield municipals are up 7.3. High yield itself up 3.95. That's the one we have on here. Bank loans are up 3.5. And even just municipals, the municipal bond index is up 1.9. So just like we said, just like with equities, we have to be very tactical. The same holds true with the fixed income markets as well. And with that, John Milligan, our CFA and our Director of Investment Operations, I'm going to have John take a moment and speak to this slide right here. John?
Sure. Thank you, Lorene. Yeah, so just a few things that have happened this year that I think are notable particularly from last year. One is we've been seeing outsized profit margins. So profit margins kind of hit a 10-year peak back in 2018 after the Tax Cuts and Job Act. And per FactSet data, they got to about 11%. And then they, as you'd have expected, dropped pretty strongly into the COVID pandemic. But then this year, we've seen a very strong spike in profit margins. Now, there's a lot of different reasons, because in the S&P 500, you've got a wide berth of different types of companies, from consumer discretionary to companies that are doing a lot more business overseas, et cetera. But a big explanation for it is just consumer demand. Consumer demand is off the charts. There's a lot of money out there, a lot of people trying to buy everything that is available. And so that's a big reason why you're seeing strong profit margins. Companies don't have to discount products as much, et cetera. And a lot of companies did a lot of cost savings during COVID pandemic, and they're still kind of reaping the benefit of that a little bit. The other thing that was notable was the annualized inflation rate. If you've listened to the Fed at all, they've talked about the inflation rate being transitory. So in 2020, we saw very low inflation rates. Things weren't being marked up, and there's less spending activity during the bottoms of the pandemic. And now, all of a sudden, with everyone trying to buy everything, we're seeing the inflation rate, come back at a very strong pace. And so they're claiming that's very transitory. A lot of it is in transportation. A lot of it's in, automobiles, as you probably have heard with the semiconductor shortage. They can't get enough new cars on the lot, so used cars. Recently in June just had their biggest month-over-month increase in pricing. And so across the board, there is growth in CPI, but it is very particular to certain areas right now, and keep an eye on it to make sure, or to watch to see if it grows in other areas as well. And then lastly, GDP growth. And so we're expecting strong GDP growth this year. We got a good first quarter, and we're expecting a near record-breaking second quarter of 8.5%, and actually came in a little bit lower at 6.5%. A big reason why is that, businesses want to produce. They want to fill their inventories. Inventory levels right now are a little bit lower. And, so the actual measure coming in 2 percentage points lower is largely due to the fact that, businesses aren't able to produce as much as they want to produce. So the good news is that typically you see economic growth when inventories are low. So if you look at inventories and they're low, you could expect some growth because businesses are going to likely do a lot of work, a lot of manufacturing to kind of break up that low level. And I'll pass that back to Lorene.
Thank you, John. We're going to be talking more about thank you so much, John. We're going to talk more about inflation in a moment. So let's go into this next slide here. And John, I'm going to have you talk about this one as well, just talking about our economic forecast 2020, 2021, and the revisions that we've been making.
Yeah, and I mean, another theme for this year is that Wall Street analysts and economic analysts have tempered their expectations, and it's been tempered because of uncertainty. We don't really know, as financial analysts and economists, how the virus will play out. So the forecasts have been tempered down a little bit, and as things have improved and vaccine rollouts have improved, forecasts have been adjusted up and up continuously. Like we recently had for Q2 the strongest increase in analyst earnings expectations. So if you take the beginning or the end of Q1, beginning of Q2 to the end of Q2, Wall Street analysts increased their expectations of earnings for Q2 by the most on record. And we're also, that's not just, just isolated to corporate earnings. It's reflective of the economy as a whole. We keep increasing our expectations. So at the beginning of 2021 for the United States, it was expected to be 3.9%, and it's been our estimate had been increased all the way up to 6.5%. And that kind of growth isn't global right now. There's other places, emerging markets, Eurozone, that are still a little more locked down, don't have as many vaccines rolling out, et cetera. That's going to slow them down for this year, but going beyond 2021, there could be some strong growth there as well.
Right. And so what is notable is that the US has recovered in a dramatic way, and other areas of the world are somewhat behind us. But like John was indicating, we expect that to improve around the globe as they are behind us. So looking at this, as far as economic forecast, the US economy has surprised the upside. And a lot of that has to do with vaccinations, of course, and the rate of people getting vaccinated, as well as record stimulus, money going into the economy. And that's not stopping. We heard today about, or even last evening, about the stimulus package that looks like is going to get approval. And then there's another $3.5 trillion package through reconciliation. And so that's more money into the economy, good, bad, or indifferent as far as what you think about it. There is going to be this added money into the economy, and that's good as far as adding money in the shorter term into the economy. Globally, Europe and Japan have been slower to move past the pandemic. However, once they are able to get more vaccinations, reopening, et cetera, they will be similar to the United States as far as our own reopening and our own economic growth. So while many areas in emerging market have been concerned about the COVID caseloads, the lockdowns have not been as severe as some of the developed nations. They're just going on. So many of these areas are areas of opportunity as far as going forward. Here, if we look at the average length of an expansion, so let me just take a step back, remind you, when we talk about recovery, when we talk about bull market, it's another way of saying an expansionary economy. When we talk about contraction, that's a recession. So we're still in an expansion mode and an expansion forecast. And the average length of expansions or bull markets in years is typically 5.3 years. Some expansions have been longer, some of course have been shorter, but the average of that 5 years is something to think about. Now, when there's more growth or faster growth, those expansions can be shorter. And when it's slower growth, those expansions are longer. So let me give you a for instance. The last expansion that we had was coming out of the Great Recession of 2009. It lasted a full 10 years, almost 11 years. That had to do with the fact that we had very slow growth of around 2% per year for those 10 years. So what I would say is when we have faster growth, and we're seeing that now, faster growth than, let's just call it 2%, we can expect this expansion to be shorter, but it could very much be in line with the average. What all of this says, though, is that we don't expect it to all of a sudden next year that we're in a recession. We don't see that at all. So we see the expansion continuing. With that, John, I'm going to turn it over to you to talk about the US dollar.
Thank you, Lorraine. Yeah, so, as most of you likely know, the U.S. is a historical net importer. And, with that, we've carried a trade deficit. However, since the pandemic, so you can see there on that chart that there's the steepest decrease there on the trade deficit is kind of on the furthest right there. And then also, we have what's called the twin deficits, and the other one is the budget deficit. And so these twin deficits are actually working right now with their, if you see on the far right there, both of their sharp decreases. These twin deficits are actually working to weaken the US dollar relative to an international basket. And so weakening of a dollar, it's not great if you want to travel abroad and and do things like that. But for an investor, it could have some positive implications. And so, I mean, it's good for businesses located in the U.S. that want to export, and it's good for investors who take their dollars, buy foreign investments, then translate it back into dollars as the dollar weakens, because weaker dollar means you get more of them back. So there's going to be opportunities here, and that's one of the things that we'll be looking for, and as we get into the second half of the year.
Thank you, John. Okay, let's turn to this I word, inflation. It's been the buzzword of 2021 so far, and I expect it to continue. And the reason is we know we're seeing record fiscal stimulus. We've seen the supply chain bottlenecks. We've all heard about the semiconductor shortages, which is a big reason why the used car market has been such an issue. And then a potentially tightening labor force, and then a nearly open recovery. The threat of inflation is real and it's here. And so one thing I want to mention is, as far as investing, you always want to outperform inflation, because inflation, you've heard me say, it's that silent killer to your money. So the adage of cash is king is absolutely not true when you have inflation, because inflation is eating away at that cash. So it's looking to, how can I keep up with inflation and how can I outperform inflation? And so certainly this makes cash not very attractive as we see inflation continuing. I'll also mention that while the Fed keeps reiterating that they think inflation is transitory, we have our doubts about that. We think it's more sustained. We don't think it's going to be out of control inflation, but we do think it's going to be much more noticeable than it's been in the last decade. So in the last decade, when we saw 2% or less of inflation, I think over the next decade, we're looking at above 2% inflation, maybe 2.5% of inflation. So like I said, doesn't mean that's runaway inflation, but it will be noticeable. And once again, when it comes to investing, you want to make sure that you're outperforming that. When we look at a lot of different reasons for inflation, we just look at, you've heard about the lumber prices. We saw the lumber prices shoot up by 300%, and then we saw them crash again, down 50%. So there's been that kind of volatility in some areas. But what we've also heard, and let's just take lumber and steel as an example, is what we've heard from the home builders is that they are not going to, even though those prices have started to come down, they're not going to pass the savings along to consumers. They're going to keep it as additional profit, all down to the bottom line. And so I would say that when we see companies continuing to do that, that's going to just further inflation. The goods and services are going to cost more. So we have to take that into our thinking when it comes to investing. So now let's talk about taxes. We do expect taxes to go up. So we've enjoyed a very low tax environment for a long time, and that's not sustainable with the amount of fiscal stimulus that we've seen come into our economy. So there's got to be a way to pay for it. So now the way to pay for it under this administration is going to be address taxes. Now, we don't know what that's going to look like. There's still a lot of debate on what that's going to be. But what I did want to show you here is a lot of people ask the question, what is that going to mean as far as my investments if we get tax hikes? So certainly there's the talk about both corporate tax hikes as well as individual brackets and individual taxes going up. This chart shows corporate tax hikes, when it happened, what happened in the market in the next 3 months, the next 6 months, and the next year. And you can see, if you look at the bottom, as far as the averages were still positive. The median was positive, and you can see at the percent of the time that was actually positive. So there have been some times when it was not positive, but overall what ends up happening is companies make adjustments and companies move on. While they may not have as much growth, because that's definitely going to impact their bottom line, that means that's going to impact their net profits. Like I mentioned before, we're probably going to see that passed along once again to the consumer. Any kind of either inflation or taxes will eventually go to the consumer. And of course, our economy is it's a consumer-led economy. Almost 70% of our GDP is derived by consumers. So the consumers have to still be able to spend. And the question here is, of course, how long can consumers spend? With that, I just want to point out the latest, as far as checks in the mail, has been the child tax care credit that is going out to millions of Americans in the form of $250 to $300 a month per child. And that's more money in consumers' pockets. Once again, may not agree with that policy of money going to individuals, but it's there and means that that is more money that people can spend, and certainly will help that middle-class consumer as far as spending goes. So here, if we look at bull markets since 1950, we're just going to talk about the average S&P gain during the second year has been about 13%. Now you remember the number that we've already seen in the S&P 500 has gotten us to that point. We're already there. The SPX now is at 4420, and that puts us at 4400 and right there. So basically we're there. So we're at the average for the year so far this year, which of course leads to the question, now what? Now what do we have in stocks? What can we expect? And I think it really goes back to the fact that we are still in recovery and we still see fiscal and monetary stimulus that's going to be additive. So the more that that happens, let's just take the infrastructure package alone. That's going to be money in the economy over the next 10 years. It's money that's being placed into the economy for infrastructure over the next decade. That certainly will help as far as equities go. Oh, here's that chart that I can show you here where we're just looking at returns. Here on the left is that return box that we saw, but over to the right, what you can see here is the sectors. So if we look at sectors year to date and where there's been some of the most gains, certainly energy. Energy came off of such lows. You'll remember during the pandemic that how low energy really got. So we've seen a big boost. That's somewhat temporary to get back into a normalized level. And then if we look at other areas of the market, some of the areas that we've been talking about, financials, industrials, technology, communication services, real estate, healthcare, you can see all of those numbers there as far as sectors. So now let's talk about the business cycle. So the business cycle is that economic cycle that says we're in a growth stage, expansionary stage, and then we go into a recessionary stage. And then once again, we start it all over again. So where are we in the business cycle? So if we look at this, and that's why at the end of this last year, we were saying, hey, we're in early stage recovery, and we've been talking about investments that do well in that early stage recovery. And right now we're saying we've kind of moved to early mid. So we're kind of moving into that mid-stage recovery of the economic cycle as far as the US. And you can see on this chart how the Eurozone, UK, Japan, how they're behind us and why we're saying there's still room for them as well to grow. And in a lot of ways, we do actually think that we've been peaking in this last quarter as far as earnings growth that we've seen. We saw some spectacular numbers, and that was coming off, like I said, of Q2 2020. John, do you have anything more to say about this chart?
No, it's just, how is this going to dictate, our investing going forward? And if you would have saw on the previous chart, things like industrials typically do well in the early cycle. But that's actually been a little bit held back while people wait for some of these packages to get passed through. So as we go in the mid-cycle, I think you're going to have some of the same opportunities you'd have previously, but also some of those early opportunities are going to show up in the mid-cycle as well.
Right. And if we look at this next chart, this just talks about each part of the economic cycle. And this has to do with historically what has done well. Now, this cycle has been a little bit different, right? Global pandemic, a little bit different. But this is why early in the cycle, we were talking about real estate, financials, consumer discretionary, technology. You can see that those are all great areas to be in the early stage cycle. And then if we're moving into mid and what we're looking at, communication services, information technology still. And in this cycle, we still think some of those other areas, because of, for instance, the infrastructure package, industrials, we still think have more room to grow. So certainly these are why one of the things that we look at as we're looking, where are we in the cycle and what areas of the market do well in that particular part of the cycle. So now let's talk about fixed income. As I was saying before, fixed income, the ag, not a lot of movement there, not a lot of opportunities, and definitely though, it has a place. Your fixed income has a place, but like I said before, we're very tactical with where that fixed income is. So we're not just using the Barclays Ag as the index, but we're using those other areas of the market. In fact, one of the areas of the market that we're looking at to add as we're about to rebalance portfolios is adding emerging market local debt. And that has a lot to do with the fact that we talked about emerging markets being behind us as far as their economic recovery. Their yields in emerging market debt are much higher than they are on our US debt. We feel like the risk is going down as far as risk levels are concerned, and that the opportunities there, especially with the dollar going down. So as the dollar decreases, and by the way, what we didn't really talk about, is those cycles of the dollar tend to be 7 to 8 year cycles. And both whether the dollar is strengthening or the dollar is weakening, and our expectation is that that's going to continue for many more years. So with that, we need to look internationally. So we need to look internationally both on the equity side as well as the fixed income side. Other areas that we have in our portfolios are those areas that I was talking about earlier: TIPS, bank loans, high yield, and even high yield municipal. So going forward, what are we saying? Where are we going from here? Some of this is what you've already heard me talk about. First one, style rotation. We definitely think that cyclicals are going to outperform in that second half of the year. So this is what I was saying early. Early in this year, the value play, which are the cyclicals, were doing very well. And then the large growth and technology kind of grew up to where it is and somewhat now equal now. Now, in the second part of this year, we actually are going to have more of a value tilt as we expect the value will outperform the growth areas of the market. So that's a continued theme that we see. Also, small caps, we talked about that. We'd already added small caps as historically outperforming in bull markets and in early stage. And we still think that those valuations are in that reasonable range. And we expect those to continue to rebound. And then developed international. So we continue to want to see increased exposure internationally. That same theme that international is behind us in the US. So where we've seen the great run-ups in the market, they have those opportunities as well, something somewhat similar. And then to use bonds as a buffer. So while the bond market may not be, it's not really where you're going to make your money, but it's going to help be a diversifier against big movements in the market. So if you're closer to retirement, you're in retirement, you're uncomfortable with the full market volatility, then you really need that fixed income to act as a buffer. It also means that you need to realize that on your returns, they're not going to be the full equity returns of, like we talked about, 18% in the S&P 500, but you are still moving forward with that comfort level of having a diversified portfolio. Risks. Now let's talk about risks in the market. So risk with the market is the Delta variant and other potential variants that come in. And what does that mean for the economy? What does that mean for businesses? Are businesses going to have to, send people home and do remote or more remote? Are businesses going to shut down? Are people going to be reluctant to get on airplanes and travel? All of that, those are certainly risks in the market. Our view is that we're going to push through, we're going to continue to recover, and that while we'll see some setbacks, that certainly we're still in that recovery mode, like I said. So you can expect some volatility in the market. The markets are also looking at what is going on with inflation. How are we looking at that? And is the Fed going to respond appropriately? So one of the big risks with inflation is, will there be a misstep with the Fed as far as what they're doing about inflation? Will they act too quickly, or will they not act quickly enough? We heard yesterday that they talked about tapering, but they're not giving a timeline for tapering. And then we know that there's also a divide within the Fed on some of the Fed presidents feel like there needs to be the tapering starting sooner, some want to wait longer. So you still have a divided Fed. They haven't come to consensus yet. They're talking about it. So they're trying to figure out when to do that. So a potential misstep of the Fed is certainly one of the risks out there. In fact, if we look at prior recessions, most of the recessions have been a Fed misstep. And then the other one is slower growth due to less fiscal support. So we still think there is going to be fiscal support. Like I just mentioned, we still think that this is going to happen. So with that, that would be positive, at least in the short term, for the market. So those are some of the risks. Now let's talk about some other things that, as it really relates to you and thinking about your own questions that you might have. One thing that I want to address is, because we've seen the CPI numbers go up so substantially, for those of you who are receiving Social Security, you're going to get an increase next year. Social Security Administration has a couple more months to determine what that increase is going to be. We expect that increase to be between 4.5% to 6%. So a sizable increase for 2022 from what you've been receiving in 2021. So keep that in mind as you're thinking about things. We're going to see most likely a large increase, and they're continuing to look at the data before they determine that number. But that's something to consider. When it comes to your investments, we definitely want to talk to you individually and understand more about what you're thinking. One note I'll make is that what we're seeing as far as people's investments in the market is that after Q1, we saw the US investor on average had 59.5% of their portfolio in equities. That's a pretty high number because you're taking all people in the United States investing with all risk profiles. So typically that number would be a lower number. And when we have a number that's that high, going forward, returns in the S&P 500 have historically been lower. And what I want to mention about that is that we've had a great run up in the S&P 500, but for those of you who have been focused on that, we are talking about those other areas of the market that we actually think have a better opportunity from where we are now going forward. And specifically, I'll mention it again, but adding in small and mid cap, adding in value, not just blend, and having kind of that tilt, adding in international, looking at developed international, and then, some areas of emerging markets. So certainly a lot of other areas of the market to be invested in. And with that, and now I want to take any questions that you have. And let me see, let me go back to my screen here. There we go. So with that, if you have any questions, we would be happy to answer them. If you do, if you'll unmute your line for a moment, and we're here to answer your questions.
This is Lisa. I've got a question.
Great. Hi, Lisa. How are you?
Hey, good. If the government starts to put more restrictions on COVID and starts to shut down the economy, does that kind of change your strategy? How do you handle that?
Great point. So what we saw with the lockdowns is that there was really, in a sense, a COVID play on what did well. We called it the stay-at-home play of the market. And then to counter that is the reopening trade. And so certainly if there is that idea of more lockdowns, then it's back into that lockdown trade, as it were, versus the reopening. And the areas that did well were in that growth area. So that's why we've said in this year of having the balance or the ballast between the two. You don't want to get rid of all your growth, but you really want to have value. And then, like I said, that the value shot up at the beginning of the year and then the growth took off. So you don't want to, it's so skewed that you're not invested in both parts of the market, because especially to your point, if we have more lockdowns, growth will probably surge again. So while we do think that there's this shift towards value, we're not giving up all our growth. So yes, always we have to look at whatever's happening in the economy to determine our thought process on where to over underweight, where to make those shifts. Does that answer your question?
Yes, thank you.
Thank you for the question. Any other questions? So as always, we want to talk to you one-on-one about your own specific portfolio, your own financial situation, and how we can help you allocate properly. I will say that in a year like this year, when we have such stellar equity numbers, it goes back to people tend to say, I want more equity exposure. And what we always want to caution with that is that volatility is not over, and that volatility doesn't just go one way. We've had volatility up year to date, but it wasn't what last Monday it was when we had that volatility on the downside, and it was short-lived, and we believed it would be short-lived, but you can always have volatility in the market. So we want to help you to be allocated properly for your own risk tolerance. And certainly if you want more equity in your exposure, we certainly can do that. But we don't want you to go beyond your true risk tolerance, so that if there was a 10 or a 20% decline in the markets, we want to make sure that you can sustain that. And then I just want to leave on the note again that we still are in an expansionary phase of the markets. So even if we have a correction, which can always happen, 10% can always happen in a correction, we still think that we have room on the upside. We're not done with our bull market. So hopefully that's good news for everybody. And once again, you can reach us at 949-748-1177. Give us a call with any questions. We look forward to talking to you one-on-one. Thank you for participating in our mid-year outlook.